Buffett sold every share of Apple. That exit just swelled his cash pile to over $300 billion. More than the GDP of a mid-sized European nation. This isn't idle wealth. It's a war chest, a declaration. Buffett has built an army of liquidity, but the question lingers. Why? Why sell Apple now, when the stock market remains in its longest bull run in history? Buffett's reputation as the ultimate optimist is legendary. He once called the stock market a voting machine in the short term and a weighing machine in the long term. Yet here he is, betting against the market's own narrative. While others chase growth stocks, he's loading up on treasury bills, safe, predictable, and yielding a respectable return. It's a paradox wrapped in irony. This isn't just a trade, it's a signal. Buffett's moves have always been more than transactions. They're declarations. When he bought Coca-Cola in the 70s, it was a vote of confidence in American consumerism. When he piled into banks during the financial crisis, it was a bet on resilience. Now, selling Apple isn't about the stock's performance. It's about something deeper, something structural. Apple was once the darling of Buffett's portfolio. A company he believed would grow indefinitely, but growth isn't infinite. The hardware cycle is predictable, and Apple's dominance is being challenged by new competitors. Buffett's brain trusts these shifts. He's not selling because he's lost faith. He's selling because he's seen the future and it doesn't look like the past. The market has long celebrated Buffett's patience. But patience without foresight is complacency. His exits have always been timed with precision. Selling GE in 2009 before the crash, exiting railroad stocks in the 80s before deregulation. Now, he's doing it again. The question is, what does he see that the rest of us don't? Berkshire's cash hoard isn't just a safety net. It's a weapon. With over $300 billion at his disposal, Buffett can act when others can't. He can buy distressed assets, fund startups, or even influence markets. But why hold so much cash now? The answer might lie in the macroeconomic landscape shifting beneath us. Buffett's shift from equities to treasuries isn't just about yield. It's a bet on stability. Inflation is sticky and markets are volatile. Treasuries offer predictability. But why does this matter? Because Buffett's moves often foreshadow broader trends. If he's betting on treasuries, what does that say about the future of growth stocks? The exit from Apple isn't about timing the market. It's about timing the economy. Buffett has always been a student of cycles. He knows that every boom has a bust. Every dominance has a challenger. His liquidation of Apple is less about the stock and more about positioning Berkshire for what comes next. The question is, what's coming? Buffett's followers often repeat his mantra. Be fearful when others are greedy, and greedy when others are fearful. But this time, he's doing something different. He's not just reacting to greed or fear. He's anticipating the end of an era, the era of endless growth, of tech dominance, of passive investing. His moves suggest he's preparing for a world where old rules no longer apply. The market's ultimate optimist is quietly betting against itself. While others chase the next big thing, Buffett is building a fortress. His cash pile isn't a mistake. It's a strategy, it's a signal, and it's a warning. The question isn't whether Buffett is right. It's whether the rest of us are ready to see what he does. Buffett's liquidation of Apple isn't just a trade. It's a masterclass in reading the unseen. The market rewards those who see what others can't. But what if the real lesson isn't in the stocks he buys or sells, but in the timing of his exits? What if the greatest investment isn't in the future, but in understanding when to walk away? The Oracle of Omaha has always been ahead of the curve. But this time, the curve isn't just bending. It's breaking. The question is, are you ready to see it? In the spring of 2016, Warren Buffett's Berkshire Hathaway quietly purchased its first meaningful stake in Apple, a company he had once called a toaster with a computer inside. Yet within 4 years, that modest investment would balloon into a treasure trove worth nearly $170 billion, transforming Apple from a speculative gamble into the crown jewel of his empire. Buffett's bet on Apple wasn't just about the stock's rise. It was about defying his own rules. He had spent decades preaching, never invest in what you don't understand. Yet here he was, pouring billions into a tech giant he once dismissed as overhyped. The irony wasn't lost on Wall Street. The four giants' portfolio, Apple, Bank of America, Coca-Cola, and Chevron, became the backbone of Berkshire's strategy. Each was a titan in its industry, but their concentration risk was masked behind Buffett's unshakable conviction. To outsiders, it looked like genius. To critics, it was a house of cards waiting to collapse. By 2021, the first cracks in Buffett's fortress began to show. He started selling his bank stocks, Wells Fargo, Goldman Sachs, U.S. Bancorp, one by one. The market chalked it up to regulatory concerns or profit-taking, but insiders noticed something far more telling. The exits were coming before Apple's. Buffett had long preached that never sell a wonderful business was his golden rule. Yet by 2023, he was quietly liquidating his positions in the very banks that had once been his pillars of stability. The message was clear. Even the oracle could see the writing on the wall. The psychological trap was simple. Buffett's followers had turned his words into dogma. Retail investors, mesmerized by his track record, bought into the narrative that never selling was the path to wealth. They ignored the valuation gravity pulling down even the most beloved stocks. Buffett's Apple stake had grown from $36 billion to $170 billion, an achievement that defied logic. But logic wasn't what built his empire. It was the ability to see what others couldn't. The moment when a forever bet stopped being a bet and became a liability. In the spring of 2023, Berkshire Hathaway's board approved a historic sale of its Apple shares. The decision sent shockwaves through Wall Street. Not because it was unexpected, but because it marked the end of an era. The four giants had once seemed unassailable. But even the mightiest structures have their foundations. Buffett's genius lay not in holding forever, but in knowing when to walk away. The bank exits had been the first whispers of change. But it was Apple, the jewel in Berkshire's crown, that would become the canary in the coal mine. The moment Buffett realized his forever bet had become a millstone. We upload videos like this every day. Subscribe so you don't miss out. Television. Buffett's followers had been taught to revere his patience. But patience without judgment is just stubbornness. And stubbornness, even for the oracle, has its limits. The psychological trap was deeper than anyone realized. Buffett's followers had turned his philosophy into a religion. And religions, once questioned, can become dangerous. Buffett's Apple stake had grown into a titan. But titans, too, can become albatrosses around the neck of even the greatest investor. The question now was, how long could he hold on before the weight became unbearable? The architecture of the forever bet had been flawless, until it wasn't. Buffett's genius had always been in recognizing when the architecture itself had failed, and now, he was pulling the plug. In the rarefied world of high finance, Warren Buffett's Berkshire Hathaway has been quietly executing a historic liquidation of its crown jewel, Apple, leaving investors bewildered by the oracle of Omaha's uncharacteristic caution. The Berkshire Hathaway cash pile has breached the unprecedented $300 billion mark, a war chest larger than the GDP of most nations. And yet, Buffett's confidence in the market's ability to deliver returns has begun to waver, sparking a flurry of speculation among market analysts. Buffett's long-held mantra of price versus value has been upended by the reality of Apple's mature hardware cycle, where 30x earnings on a mature business model have become a recipe for disaster, violating the oracle's own margin of safety. The tax alpha maneuver, a masterstroke of financial engineering, has allowed Buffett to lock in 21% corporate long-term gains, a $20 billion-plus savings that would have been impossible to replicate in a rapidly changing tax environment, where potential hikes could have wiped out the entire gain. The macro pivot, a seismic shift in Buffett's investment strategy, has led him to interpret the shift to short-term treasuries as a bet on fiscal dominance and sticky inflation, a move that has left investors scratching their heads in confusion. The CAPEX cycle signal, a warning bell that has been sounding for months, has been validated by the massive AI spending by the Mag 7. a move that has left Buffett's reluctance to fund capital intensity at peak multiples looking prescient. The massive AI spending by the Mag 7 has been a major contributor to the current crisis, a harbinger of the darker times that lie ahead, and Buffett's reluctance to fund capital intensity at peak multiples has been vindicated by the oracle's prescience. As the dust settles on the current crisis, one thing is clear: Buffett's prescience and willingness to take bold moves have saved his investors from the worst of the downturn. His unyielding commitment to his investment philosophy. In the aftermath of the current crisis, Buffett's willingness to adapt and evolve his investment strategy has saved his investors from the worst of the downturn. His unyielding commitment to his investment philosophy. The Oracle of Omaha's willingness to take bold moves has saved his investors from the worst of the downturn. His unyielding commitment to his investment philosophy. A shining example of the power of adaptability in the face of uncertainty. In the end, it is not the market's ability to deliver returns that has saved Buffett's investors, but the Oracle's willingness to take bold moves, adapt and evolve his investment strategy, and stay true to his unyielding commitment to his investment philosophy. The Oracle of Omaha's unwavering commitment to his investment philosophy has saved his investors from the worst of the downturn. The power of adaptability in the face of uncertainty, and the importance of staying true to one's principles as the dust settles on the current crisis. One thing is clear: Buffett's willingness to take bold moves, adapt and evolve his investment strategy, and stay true to his unyielding commitment to his investment philosophy has saved his investors from the worst of the downturn. The Oracle of Omaha's unwavering commitment to his investment philosophy has saved his investors from the worst of the downturn. The power of adaptability in the face of uncertainty, and the importance of staying true to one's principles. The current crisis has left many investors wondering if Buffett's willingness to take bold moves, adapt and evolve his investment strategy, and stay true to his unyielding commitment to his investment philosophy has saved his investors from the worst of the downturn. The Oracle of Omaha's unwavering commitment to his investment philosophy has saved his investors from the worst of the downturn. The power of adaptability in the face of uncertainty, and the importance of staying true to one's principles. The S&P 500 is no longer a broad market. It has become a hostage to 7 megacap technology giants. This extreme concentration is dangerous. It mirrors the dot-com madness of the early 2000s. The index is pricing in perfection for a few companies. Passive funds pour billions into these leaders every single day. This creates a self-reinforcing feedback loop. When the giants rise, the whole market rises. When they fall, the whole market crashes. It is a fragile illusion of stability. Nvidia and Microsoft now account for a massive percentage of the index's total return. Their performance dictates the fate of millions of passive investors. This level of dependency is unprecedented in modern financial history. It is a single point of failure waiting to happen. We have seen this movie before, but the stakes are higher this time. The dot-com bubble eventually burst with catastrophic force. History suggests that extreme concentration always corrects itself eventually. The market is overdue for a painful rebalancing. While everyone watches the tech stocks, a silent storm brews in commercial real estate. Office buildings across major cities are sitting empty. The commercial property market is facing a liquidity crisis that few are discussing openly. It is the hidden beginning of a larger collapse. Regional banks are heavily exposed to this crumbling commercial real estate debt. They are the first line of defense in the crisis. When the loans go bad, the banks suffer immediately. This creates a domino effect that threatens the entire financial system. Warren Buffett holds over $300 billion in short-term U.S. treasuries. This cash pile is larger than the GDP of most nations. It is a war chest designed for the coming storm. He is prepared for a liquidity crisis that others are ignoring. In the quiet corner of an Omaha office, a stack of Berkshire Hathaway annual reports lies open, pages filled with Warren Buffett's handwritten notes. Some crossed out, others underlined in bold. The ink glistens under the soft glow of a vintage desk lamp. This isn't just a portfolio, it's a fortress. Buffett's philosophy has always been simple. Buy wonderful businesses, hold forever. But cash was the enemy. It dragged returns down. Yet here, in 2023, he's sitting on $300 billion in treasuries. The man who once called cash a drag is now hoarding it like a king guarding his gold. The shift isn't just about money. It's about control. Buffett's cash pile isn't idle. It's a call option, no strike price, infinite expiration, a hedge against the unknown. The day the market crashes, the day inflation spirals, the day a recession hits, cash lets you act. It's not an expense. It's insurance. Taxes, they're the silent killer of wealth. Buffett's Apple sale wasn't just about valuation, it was about timing. By locking in gains at 21%, he avoided a potential 28% rate. That's billions saved. The difference between genius and mediocrity isn't what you own. It's when you sell. Buffett's circle of competence isn't just about knowing a business. It's about knowing when it changes. Apple wasn't a bad investment. It was a business that evolved. The hardware cycle peaked. Capital expenditures soared. The moat shifted. He didn't sell because he lost faith. He sold because the rules changed. The world today isn't about productivity. It's about deficits. Governments print money. Inflation sticks. Nominal growth becomes the only game in town. Buffett's treasuries aren't a bet on interest rates. They're a bet on fiscal dominance. The future belongs to those who understand that money isn't just made. It's printed. Imagine a balance sheet that's not just strong. It's a fortress. Cash for opportunities. Tax efficiency to preserve wealth. Discipline to know when to walk away. Buffett didn't build Berkshire by holding forever. He built it by knowing when to adapt. The lesson? Your wealth isn't about what you own. It's about how you prepare for the storm. But here's the question. Are you building your own fortress? Or are you still chasing the myth of the forever hold? The market rewards those who adapt. And the storm is coming. Are you ready? Buffett's cash isn't a mistake. It's a masterstroke. Every dollar is a weapon. Every exit is a lesson. The real question isn't what you own. It's whether you're prepared to fight for it. The battle for wealth isn't about buying right. It's about surviving the storm. The lesson isn't just about Buffett. It's about you. Your portfolio isn't a collection of stocks. It's a blueprint for survival. And survival isn't about luck. It's about preparation. So ask yourself, what's your fortress look like? Buffett's Apple sale wasn't a failure. It was a pivot. The market rewards those who pivot. The question is, are you ready to pivot when the time comes? Because the only constant in investing isn't change. It's the need to adapt. The fortress isn't built in a day. It's built in moments of clarity. Moments like Buffett's Apple sale. Moments like holding cash when everyone else is chasing stocks. The difference between success and failure in investing isn't knowledge. It's foresight. And foresight comes from preparation. So build your fortress. Hold cash when others panic. Sell when the business changes. And when the storm hits, because it will, you'll be ready. The question is, are you building yours now? What is the dark truth behind this event? Share your theory below and watch our next investigation. Hi everyone. Quick reminder. Subscribe for high-quality daily content. Sparkles Part 2 is dropping tomorrow. Subscribe for notifications. Loudspeaker.